There's a concept from chaos theory called the butterfly effect. The idea that something tiny on one side of the world can set off something violent on the other side. In markets, that's not a metaphor, it's the wiring. And right now, the butterfly isn't flapping, it's throwing a punch. Because while everyone's glued to the Fed, arguing about elections, inflation prints, and whatever headline is screaming today, most people are missing the single most dangerous chart in global finance flight. It's a chart that just snapped a trend that held for decades. It's not in New York, it's in Tokyo. The 30-year yield has surged to 3.5%. The 10-year is above 2.1%, at levels we basically haven't seen since the late 90s.
And if your first reaction is, okay, and? How? That's exactly why this matters. Japan has been the world's cheapest funding source for decades. Near zero rates. Endless yen liquidity. Institutions borrowed that cheap yen, swapped it into dollars, and tech, real estate, credit, even crypto. But when Japan's rates rise, that ATM doesn't just get more expensive, it starts shutting down.
And when the cheapest money on earth stops being cheap, the unwind isn't slow, it's mechanical, it's forced. It looks like a global margin call.
So in this investigation, I'm going to show you exactly how a rate move in Tokyo can drain liquidity in New York, how the yen carry trade props up US interface bubbles, how repatriation pulls buyers out of treasuries, how stress from hedge funds into banks, and why the final escape hatch.
Because when systems break, they don't break at the headline. They break at the weakest link. And right now, the weakest link is the yen. People keep staring at the wrong screen. They're watching the Fed like it's the only metronome that matters. They're tracking elections, wars, CPI prints, anything loud enough to trend. But the next real shock doesn't announce itself with a headline. It shows up as a quiet line on a chart that almost nobody checks because it's just bonds. That assumption is the trap. Here's the uncomfortable truth. The most dangerous chart in global finance right now isn't in New York, it's in Tokyo.
For decades, Japan played a role the world got addicted to without admitting it. Japan was the global ATM.
That wasn't a side story, it was the plumbing. Institutions borrowed in yen, converted it to dollars, and piled into higher return assets across the West.
And so per se. Stocks, bonds, real estate, crypto, anything with yield or momentum got stuffed with leverage that started quietly.
Like oxygen, nobody thinks about it until it's gone. Now the oxygen is thinning. Japan's government bond yields have started to break a trend that held for a quarter century.
The 30-year yield pushing to 3.5% and the 10-year clearing 2.3%, levels not seen since 1999, isn't a number, it's a regime change. It's the moment the free money era starts to die in public. And if you've never paid attention to Japanese yields before, that's exactly why it matters.
This is the kind of break that only shows up when a system is under pressure long enough that the dam finally cracks.
Most people hear rates up and think, that's a Japan problem. That's the second trap. Because the carry trade doesn't unwind like a debate.
It unwinds like a margin call. It doesn't ask whether a company's earnings are strong or whether the economy is resilient. It doesn't care what your narrative is.
It only cares about funding costs, currency moves, and leverage. When the cheapest funding in the world stops being cheap, the math flips.
Positions that look safe at 0% funding suddenly bleed at 1%, 2%, 3%. You're leveraged, forced. Forced closing of trades. Fast, ugly, and contagious. That's why the Tokyo chart can become a New York crisis without asking permission. The promise of this investigation is straightforward. We're not doing vibes, we're doing mechanics. We're gonna walk the pipeline step by step through the parts. Part one is the hidden engine, the yen carry trade, how it built a scaffolding under Western markets, and why it can unwind violently once funding repriced. Part two is the money vacuum. When Japan's yields rise, capital has a reason to come home. And repatriation doesn't just move money, it removes buyers from US
Markets at the worst possible time, cornering the Fed. Part three is the stress layer. Banks, derivatives, of counterparty trust that only look stable when rates behave.
And part four is the end game. What the historical playbook says happens when a system tries to cap yields, print liquidity, and keep leverage from snapping, especially for silver, the asset that tends to become an escape valve when paper claims start to look like promises you can't cash.
So if you want the real question, the one the headlines won't ask, it's this. What happens to a global market built on cheap yen when Japan stops being cheap? Because once that answer starts moving through the system, it won't matter what the news cycle is talking about. The plumbing will decide the outcome. And plumbing doesn't negotiate. If Japan was the global ATM, then the yen carry trade was the debit card. Swiped so often, that's the bridge between what you just saw on the Tokyo yield chart and what can suddenly break on a NASDAQ chart. Not sentiment, not fear, not bad news. A funding mechanism, a repeatable trick. a trade that quietly became the scaffolding under US bubbles. Here's how it works in plain English. You borrow yen at ultra low rates, sometimes near zero, sometimes effectively negative. You take that yen, convert it into dollars, and you buy anything in the US.
Inventory that offers more return or more upside. Tech state, real estate, high yield credit, crypto, even treasuries.
Yes. You're paying almost nothing to borrow and earning more somewhere else. On paper, it looks like free money.
Nice. Then they leverage it. Then they repeat it across desks, funds, and banks until what beganks.
That's why you can have a market that feels invincible even when growth is uneven. It isn't invincible. It's funded. But here's the part most people miss. The carry trade has two hair triggers, and both sit inside Japan. Trigger one is rates.
The trade only works while Japanese funding stays cheap. When Japan's yields rise, the cost of that funding rises with it. The spread compresses.
Suddenly, the free money isn't free. It's expensive. That shift doesn't happen gradually in a leveraged system. It flips.
Profits turn into losses fast, and losses in leveraged land don't ask for your opinion. They demand collateral. Trigger two is the currency. If the yen strengthens against the dollar, your debt gets heavier. You borrowed yen, you must repay yen. If the yen rises, it takes more dollars to buy back those yen later. Even if your US asset didn't move, your repayment got worse. That's the quiet killer. You can be right on the asset and still lose on the funding. Now connect this back to the Tokyo chart from the last section. When the Bank of Japan starts losing control, when inflation pressures yields higher, and when funding regimes change, the unwind is not philosophical, it's mechanical. Hedge funds don't decide to de-risk because they saw a scary headline.
They close because prime brokers demand it. They sell because they have to repay yen loans. And what do they sell? The exact US assets they bought with borrowed money. That's the punchline. Japan's yield breakout isn't boring. It's a switch. It flips leverage off.
And once that switch flips, selling pressure shows up where it never seems to make sense. Earnings can be fine. Economic data can be mixed. Headlines can be quiet. It won't matter because this is deleveraging, not a debate. The cheapest funding currency on earth repriced, and the unwind spread, which lead to the next question you're supposed to ask, but almost nobody does. If leveraged money is forced to sell, who's on the other side catching the fall?
That last question, who catches the fall, isn't rhetorical. It's the entire story. Because once the carry trade starts winding, you're dealing with something bigger, slower, and far more dangerous. The long-term capital that has been quietly financing the US. Bond market stepping back at the exact moment America needs it most. The 3.5% on Japan's 30-year bond stops being just a yield.
Japan isn't only a country with cheap funding. Japan is also a country with colossal pools of pace money, life insurers, pensions.
For years, these institutions lived in a desert. Yields at home were near zero, sometimes effectively negative. So they did what
they bought US treasuries, they bought European debt, they bought Australian bonds. They became quietly some of the most important buyers in the global system.
And here's the uncomfortable pivot. When Japanese domestic yields climb high enough, that offshore flow can reverse fast.
Not because they suddenly love Japan more, but because the math changes. A decent yield at home has a feature foreign bonds don't. No currency risk. Matters. When you're a pension fund, extra yield is meaningless if FX swings can erase it. So once Japan's long end hits 3.5%, you don't need a panic. You need a meeting, a vote, a reallocation memo, and then the vacuum starts.
Because what does repatriation actually mean in practice? It means selling foreign bonds, especially US treasuries, and rotating into Japanese bonds.
The script's pivotal claim is that Japan holds over $1 trillion in US treasuries, later framed as 1.2 T dollars. Whether the number is exactly that or roughly that, the direction is what matters. Japan is not a minor player. Japan is a pillar. When a pillar shifts, the entire structure creaks.
Now zoom out to what that does to the US bond market.
Treasuries aren't priced like a product. They're priced like a constant auction of confidence. They need a reliable bid every week, every month, year after year, because the US rugs persistent deficits and must roll and issue enormous amounts of debt. If a giant buyer steps away, the system doesn't politely adjust. Yields rise to attract new buyers. That's the market's way of saying, pay up. And here's the contagion. Higher treasury yields don't stay in the treasury market. They leak into everything. Mortgage rates, corporate credit, real estate affordability, bank balance sheets filled with bonds that fall in price as yields rise. In other words, a Japanese yield breakout becomes a de facto tightening in America.
without the Fed touching a button. This is why the story calls it a great money vacuum. Capital doesn't disappear, it moves. And when it moves away from the world's biggest borrower, if the last section left you with the uncomfortable question, if Japan sells, who buys? Here's the part that should make you sit up. We've already seen a smaller version of this movie, and it didn't need a world-ending catalyst to turn ugly.
In late July 2024, the Bank of Japan lifted its short-term policy rate to around 0.25%.
But markets don't blow up from big numbers. They blow up from crowded leverage meeting a regime shift. And within days, the warning shot landed.
Guys, on August 5, 2024, Japan's Nikkei suffered its worst one-day rout since 1987, down about 12 points. The important detail isn't the headline, stocks down. The important detail is when the funding currency moves against you.
That day wasn't just Tokyo. Losses and volatility spilled across markets. Risk assets everywhere caught the same chill, from US
Momentum names to crypto, because the plumbing that financed risk was suddenly constricting. That's why this matters for 2026, not because the script wants drama, but because it's scaling the math.
If a quarter-point change helped trigger a violent de-risking wave when positioning was crowded, what do you think happens when Japan's long end? Order per allocation rather than a trader's opinion. In other words, 2024 wasn't the event. It was the stress test, the first time the market felt. Policymakers and central banks can patch a shock like that in the short run with soothing language, liquidity backstops, and shifting expectations about rate cuts, but patches don't remove the underlying leverage. They just postpone the moment it has to be confronted.
And this is where the timing lesson becomes the most counterintuitive part of the entire story. In the first phase of a real liquidity shock, the market doesn't behave like a textbook.
It behaves like a margin call.
Safe havens don't automatically go up, because when big players need cash fast, they sell what they can, not what they should.
Winners get dumped to meet collateral demands. Correlations snap toward one. Even gold and silver can get hit in that first wave. Then, after the mechanical selling burns itself out, the narrative shifts. Fear replaces complacency, policymakers move from confidence to containment, and the market's focus flips from growth to stability. That's when the second phase begins. Policy response, liquidity decisions,
The quiet steps that tell you the system is being supported again. So keep the sequence straight. First comes a liquidation that feels irrational. And if you want the real hook going into the next section, it's this.
The 2024 shock showed how fast the crowd can run, but entire national balance sheets quietly pulling capital home while the world's biggest bond market is still demanding fresh buyers every single week. And this is where the story takes its sharpest turn, because once you understand the two-phase sequence, forced selling first, policy response later, you stop asking the usual question, what's the safe haven? And you start asking the only question that matters. What if the safe haven is the thing that breaks? That's the psychological flip the script is aiming for.
In the first wave, everything can get dumped. Stocks, crypto, even metals, because margin calls don't discriminate.
But then it starts when the bond market, the place everyone runs to when they're scared, stops behaving like a sanctuary and starts behaving like a trap. Because here's the uncomfortable mechanic. If Japan's repatriation pressure forces US Treasury yields higher, bond prices fall and the losses don't show up. They show up inside the portfolios labeled safe. The funds that were supposed to be the ballast become the damage. The asset class marketed as risk-free reveals a hidden condition nobody likes to say out loud. It's only a risk-free if yields behave. And when yields don't behave, when they gap, reprice, or grind higher in a world addicted to cheap funding, that's when the crisis stops being about volatility and becomes about trust. Because if you can't park money in yen,
And you can't park money in dollars beats, and you can't park money in bonds beats,
where exactly do you go? This is the failed hiding places sequence that most investors never rehearse because they've been trained to believe there's always a clean exit.
The script argues that in a bond-led stress event, that comforting map gets erased. Cash is safe in nominal terms, but not in purchasing power.
Bonds are safe on paper until the market demands a higher yield. And then the price math punishes you.
even the funding currencies become unstable because everyone is trying to unwind the same trades at once. And that's the moment the story pivots to silver.
Gold and silver don't require a central bank to behave. They don't require a yield curve to cooperate.
They don't require a counterparty to stay solvent so you can get paid. They just sit there, unleveraged, uninterested in your narrative. The script leans on a historical rhythm to make this feel less like prophecy and more like pattern. In the 1970s, rates rose, bonds were brutal, and gold rewrote its price ceiling as confidence in paper promises wobbled. The suggestion isn't perfectly, and here's the curiosity hook that tees up the next part. The bullish case for silver isn't one clean catalyst, like inflation is up or rates are down. Step 1. Leverage snaps and forces liquidation, exposing how fragile the system is. Step 2. And once the market senses that the only way to stabilize the system is to create more currency to absorb more debt, the question becomes existential. Do you want to own claims inside the machine or something outside it? That's the moment silver stops being...
In the script's second act, the answer isn't inflation expectations or market psychology. It's a number with teeth.
Government has to refinance and issue debt nonstop, whether markets feel calm or not. This is where repatriation stops being an abstract flow and becomes a vacuum. The story reframes Japan's move as liquidity being pulled out of the US funding system at the worst possible time. The US is running roughly $2 trillion a year in deficits, which means the Treasury is constantly bringing new supply to market. That machine needs consistent buyers.
Not once, not occasionally. Every auction, every rollover, every month. And for years, the global bid mattered. Now the script tightens the vice. The old pillars are wobbling. China, it argues, is no longer the dependable marginal buyer.
And if Japan, the other pillar, starts rotating home because domestic yields finally pay, then the hole in demand isn't theoretical, it's structural. Someone has to step in. And once you list the candidates, the trap becomes obvious. Hedge funds can buy, but they're leveraged. And banks can buy, but their balance sheets are capacity limited. And rising yields also mark down the bonds they already hold. Pensions and insurers can buy, but they're price sensitive and won't volunteer to catch a falling knife unless yields compensate them. So the script pushes you toward the only actor left with unlimited balance sheet, the Federal Reserve. Here's the problem. If the market has to clear without that buyer of last resort, yields may have to rise a lot to attract enough demand. But once yields spike to that zone, debt service becomes politically radioactive and mathematically brutal. Every point higher isn't just tight. At that point, the Fed isn't choosing between hawkish and a dovish. It's choosing between letting the bond market reprice violently or stopping it. And stopping it has a name: yield curve control. YCC is the moment the script calls surrender. Not surrender to markets, surrender to arithmetic.
The central bank caps a target yield. The 10-year cannot exceed 4.5%, and then buys whatever it takes to enforce that cap.
Unlimited buying means unlimited money creation, and that's the hinge. The system moves from price discovery to price management, and the currency pays the bill. This is where the silver thesis gets rocket fuel. If bonds are capped, they stop being a clean refuge. If cash is being diluted to protect the bond market, it stops being a clean refuge too. Capital starts hunting for the only things not trapped inside that policy box. Assets that don't depend on a yield curve behaving or a central bank staying disciplined.
Dense. The script's instrumental trees. The script's crack lives here. The economy can feel weak, headlines can look ugly, and yet.
So the curiosity hook going forward is simple and unsettling. If Japan's yield breakout pulls the first brick out of the wall, is YCC the patch or the signal that the wall is officially being held up by printed money?
If yield curve control is the moment the Fed silently admits, we're going to cap the bond market and print whatever it takes, then the next question isn't whether hard assets benefit,
because gold is the institutional hedge. Silver is the spillover, and spillovers are where the fireworks happen. The script doesn't deny gold's role.
It treats gold like the first responder. Central banks, big funds, macro desks. When trust starts wobbling, they reach for the cleanest, deepest market.
But it argues silver has an extra gear, because silver isn't just a monetary metal. It's a working metal. And that matters when a currency shock is happening at the same time as a real economy demand pull. Start with the industrial engine.
Japan isn't a meme economy. It's a manufacturing nucleus: autos, electronics, batteries, precision components. When the yen strengthens through repatriation,
Markets can, in parallel, made it easier for Asian manufacturers to secure supply. Silver sits inside that supply chain,
It's the conductive, high-performance material that shows up where reliability matters. So while Wall Street is deleveraging, the real economy can keep tugging on the physical market.
Then comes the second engine, the one markets underestimate because it's not smart money, it's people.
That retail behavior matters because it doesn't need permission from policy, and it doesn't wait for a committee.
It shows up when fear hits the public layer, when friends start asking friends, should I be holding something real? That's when physical premiums appear. Inventory tightens, and the gap between paper price and street price starts to tell its own story. Put the two together, and you get the Scriptsal's core advantage for silver. Two engines pulling at once.
One is macro, Fed printing to absorb bond selling, which weakens confidence in fiat. The other is physical.
It takes a few unexpected flows hitting at the same time. So the hook going into the next section is this. If gold is the official, it's accounting, it's balance sheets, it's the credit layer that decides whether the system keeps breathing or starts choking. And this is where the story gets darker, because once you move from metals to money, you run straight into the one word.
Here's the bridge. Silver can outperform when confidence cracks, but confidence doesn't crack in a vacuum. It cracks when the intermediaries wobble. They're the pipes that connect hedge funds to funding, derivatives to collateral, and safe bond portfolios to the real-world need for liquidity.
When yields move fast, the damage isn't just prices went down. The damage, positions that were hedged, financed, and structured under, and the derivatives web is where that sensitivity gets amplified. You'll hear estimates thrown around, 600 trillion to 1 quadrillion notional in derivatives. The point isn't that every dollar of notional is at risk. The point is that embedded inside that ocean are contracts, especially interest rate swaps.
When rates jump, valuations move, margin requirements change, and collateral calls cascade. That's what fragility looks like.
Then the script starts pointing at stress signals, because a system doesn't break cleanly. It leaks first. It highlights Japan's Norinchukin reportedly taking large losses tied to foreign bonds, and it reminds you that US banks have carried large unrealized losses from the prior rate shock. Those losses aren't always real until somebody is forced to sell.
But in a liquidity event, forced becomes the theme. Now layer the carry trade on top. If hedge funds borrowed yen through major banks and prime brokers,
And once the market senses that upstream risk, the banking system does what it always does in stress. It pulls back. If lending tightens, credit lines shrink, banks get picky about collateral. They lend less not only to funds, but to each other. That's how contagion becomes real economy. When credit freezes, businesses feel it, consumers feel it, and the feedback loop accelerates.
in 2020, silver slipped toward $12 during the initial panic, then doubled to around $30 within months as liquidity injections hit the system.
Because it's smaller. It's a tighter market where incremental flows can create outsized price action.
If gold is around $4,500, a conservative 40-1 ratio points to roughly $112 silver.